This week on Case Studies with the Biz Doc, it's SPAC versus IPO, take two, covering the story of Root and Metromile. We covered it in the spring, and we've got the follow-up of where those stocks went, and both headed south. The whole story and how we got there this week. SPAC versus IPO, take two, and we're walking down the path with two example companies, Root and Metromile, that are both fintech companies that were in the car insurance space. Earlier this year, in March of 2021, and it's the end of Q4 2021 as we film this, if you're watching in the future, we covered Metromile and Root as they went out onto the stock market. Both were listed in the NASDAQ stock exchange here in the United States, one through a SPAC and one through a traditional IPO. The IPO side of the equation is actually more difficult to go public. It's a more rigorous process. You have to file with sec.gov, a lot of documentation. You then have to go on a roadshow where you are face-to-face with the brokers and with the analysts that'll be covering. Again, the word vigorous really applies because it's a more extended, vigorous, and inspective process. Whereas a SPAC, you're really merging with a company that's already on the market, kind of a shell. The name will be changed at the end of that to you after you merge. So the real interesting part of it is the merger with a company that's already public, and mergers can happen quick. That's the difference. But let's see, was there really any difference in performance between these two? And I just wanted to use these as an example to follow up. Well, in our last episode, we had Root, and Root was an AI-driven car insurance company. We had Metromile, also had some AI and technology as a car insurance company. It's one thing to have the technology, but it's quite another thing to have the three legs of the stool that's necessary to make a car insurance company. Number one, the product, the car insurance that you and I would buy. Number two, the AI, so that they can evaluate you in need to see what price we'll pay for the insurance and our risk to them as they're underwriting. And then lastly, sales, the engine that's out there that actually attracts us so enough people are buying the insurance, using the AI to price it for them, and then the product is appealing to those people. If you don't have all three legs, all you may have is a technology stack. If you don't have enough sales, you may never get there to break even. All of that has to be there. Let's see what happened with those three legs. Well, over here at Root, prior to going public, Root was $43 million in total revenue. This is a quick look at revenue. And in 2018, $290 million, 2020, $346 million. And then at the end, October 26th, a little over a year ago, they went out IPO at $27 a share and proceeded to plummet down below 20, like 19. But in this area, they were out and worth $6.7 billion when they went out. And they came up early in January of 21, had a little peak, but then you can see the stock over the course of the year had a couple of bright spots, but it was heading down. This is where everybody on a roller coaster and it goes click, 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 click up the top. And then what happens when the roller coaster goes down? Everybody screams. Same thing happens here. You've got investors that are screaming, analysts that are screaming, a lot of things that were going on here. Well, they came out and announced what was driving this down. They announced that they were 25% down on revenue in 2021, looking at trailing 12 months, looking back. And revenue went down 25%. But the pressure on the stock was 77%, to where right now, December 13th, as we film this in 2021, coming to the end of Q4, the stock's trading at $3.30 a share at an $850 million market cap. Hang on a second. $6.7 billion January of this year, $850 million market cap right now. There will be no dam this week. There will be no happy dam and Elon Musk rocket to Mars. We have the dam. That's what we got this week here. It's just, damn, baby, that's horrible. Well, exactly. Now, they went out with an IPO, so they had met analysts and done a lot of things. So it just goes to show you, if something is missing in a fintech company, or any other company for that matter, when you go out and go public, it may not matter you go out with an IPO, your stock's going to be under tremendous downward pressure here. So now, some people would say this is a buying opportunity, that maybe they weren't quite ready to go public. They certainly had revenue readiness, but were they breaking even? Did they really have sales codified? Did they have sales intake at the level that they needed to do? Well, I guess not, because the losses and then the sales dropped. So one leg of the stool the sales drops 25% year over year, and people are like, wait a minute, we can go out with a loss for a long time. That's pronounced Amazon, as long as you continue driving up and showing traction and revenue and market share, and that loss keeps going down over time, the market will tolerate that, say, hey, they got to grow into their future and look at the revenue and look at the positive KPIs, key performance indicators that are showing that they're on their way. Metromile goes out by a SPAC, which means that they found a company. That company had a broker or a banker that had bought that company and was going to merge Metromile into it through the SPAC process. Go ahead and Google on Investopedia the SPAC process. You'll see all the steps that go through it. Nonetheless, merging with the company and going out on the stock market is a lot easier. So here we go. They go out February 10th, 2021. This year, $1.5 billion at a little under $20 a share, and that would be the highlight of their year. Likewise, and you can take a look at this, there's something to be said that they were pushing each other down because fintech and car insurance, so this is called a market comp. And the market comps on this was not good, even though their sales were much less than their sales, their revenue numbers. So let's back up and look at the revenue numbers. So when you go out to go public, you want to be having a good talk with yourself about the revenue traction that you have. Well, 2018, it was 54 million, 2019, 52 billion, 2020, 33 billion, but then 2021, they were really on a run, and right now for the 3 quarters that have been reported, fourth quarter hasn't been reported, they're at 63 million. So a much smaller company, as a matter of fact, 5x smaller on current revenue than Root. But nonetheless, apparently they thought that that was enough to go out. Now, on a traditional IPO, they might not have got out because you might have the banker saying, look, I can't take you out at that kind of revenue. I just can't do it. But the SPAC, you can get out to the stock market. And that's one of the things that I point out here. I don't think Metromile was completely ready, but they went out with the SPAC. 1.5 billion valuation on February 10th when they go out, a peak a little over $20 a share, and the screaming roller coaster ride down to $2.22 a share right now, and a $283 million market cap with a damn baby, that's horrible. There we are. Well, what happened? If you become that inexpensive, yet they were a car insurance company using AI and a device that they would put in your car that would monitor your driving habits. So they had billions of miles of data points. That data is valuable because what they were doing is they were using real-time driving history of you and me to do the underwriting and the pricing. So that part of their three-legged stool was fine. They obviously weren't getting the revenue line moving as fast as you would want. And was the product the issue that they were offering, the car insurance coverage they were offering? Well, who knows? But in any case, it got down very inexpensive, and Lemonade came along and said, we're going to offer car insurance. And what we're going to do, Pac-Man is going to buy Metromile. Now, they bought it in an all-stock deal, and it was $500 million worth of stock. However, you could go look at the quarterly filings for Metromile and see they had something around $300 million in the bank account. So if I'm going to buy Metromile, including 300 in the bank account, wait a minute. I offer 500, but there's 300 in the bank account, so I offer 500 and I get 300 back. I just paid $200 million for Metromile. So Lemonade basically buys Metromile and a billion miles of driving history and data, which is very valuable, for $200 million. And that's called all stock net cash. I paid $500 million in stock. The net that net of cash means I really paid $200 million because now, as soon as they finish the acquisition, which had happened in Q1 of next year, 2022, now Lemonade has that, or whatever is left of it by that time, of the $300 million that is in cash. Now, it's very interesting that in the discussion of this, the positioning by Lemonade was that they were acquiring a data sciences company. So they really didn't give Metromile a lot of credit for being a really viable car insurance company, but they were very complimentary and positive, which you should be when you're paying $500 million for something, for the company, and talked about the data sciences advantages that Metromile had been able to bring to itself, and the data, the big stack of data that Lemonade was buying. I happen to think this is a good deal for Lemonade, watching this come down and say, hey, why don't we buy this technology along with all the data we get with it? And we're a fintech company. We haven't been around for 50 years, and so we can use some of the same technology and that data to offer car insurance, and they did. This is what jumpstart the Lemonade offering of car insurance. So it became so cheap that it was bought. Now, had this happened before the IPO, in venture capital circles, sometimes we call this an acqui-hires, that you acquire a company to hire some people, get a little technology and stuff, and it's really an acqui-hire because you end up with this department that you buy, like an engineering department, because you're not paying big money for revenue line, profit, EBITDA, and everything else. You're sort of acquiring a feature or a team or technology in the micro compared to the incumbents of the industry space. So there you have it. So now you say to yourself, maybe through a SPAC, Metromile never should have been out there. This is kind of light. There's not a lot of space in here and not a lot of meat on the bone in terms of raw revenue from Metromile, but nonetheless, they got out and somebody got their money off the table at $1.5 billion. Plus there was a bunch of warrants that people had, probably very inexpensively, and they were able to sell those along the way and probably still did well, even though the retail investors are on this screaming roller coaster ride to hell. But there it is. Now, over here, this is Root. The issue with Root is whatever happened, they went out with an IPO through the normal, deeply inspected process, and unfortunately, the revenue went down 25%, which pressurized the stock, and having a comp company across town, and look at those lines. I attempted to put those together as faithfully as I could, and they were sort of on the same pressurized line, which could lead people to be, a sector analyst might say, you know what, nothing good is happening in fintech car insurance. Look at these two examples. And that'll put pressure on the entire sector. So nonetheless, that's where it's at. Well, what are the lessons here? The lessons here are very simple. Market readiness is still number one, whether you're a SPAC or you're an IPO. The ability to push revenue up and to the right, scaling your operational expenses and therefore your EBITDA and your earnings per share is still number one. SPAC versus IPO, I don't think there ever was a debate. Myself and other people say this never was a debate. It is a more rigorous, more expensive, more time-consuming, and some people don't like that, think that's a pain. But when an IPO is fully executed, there's been a lot of research that goes into there, and it's one of those things you say, hey, you got no excuse. You went fully through an IPO process. Now, there have been bad companies that go through IPO processes, but typically it squeezes out and forces veracity and presentation much more forthrightly than the compressed SPAC model does, where you're merely merging with the shell, and a merger and acquisition is very easy to complete. So I don't think they should have been out. Some people may feel differently, but the only winner in this was the people that got their money out here and Lemonade themselves, whereas over here, Root went out and couldn't sustain the revenue. And the three legs of a stool for a public company that apply the same for you and me in a private company, a great product, the ability to sell it to people and keep selling it to people, replicating your sales process, and profitable operations. Those are the key to success, whether you operate a t-shirt company in Berlin, a technology company here in the United States, or you were with a group of people in fintech and you took Metromile public. Well, that's what I think in this follow-up of SPAC versus IPO and the Root and Metromile story, neither of which were particularly good. But what do you think? You've got things on your mind. Leave a comment down below. I answer as many as I can. And while you're there, please subscribe to the channel and hit the bell so you get notifications whenever we got new case studies and content here on Valuetainment, the best channel on the internet for entrepreneurial content. Until next time, I'm Ellsworth, the Biz Doc, and I hope I left you better than I found you.